Welcome to the Note Investor Podcast. We'll guide you through the ups and downs of note investing and teach you all about the nitty-gritty details of the business that other people won't talk about. Your host, Dan Deppen, is a former aerospace engineer and product manager who transitioned away from cubicle life to full-time note investing in 2018. Our website is www.fusionnotes.com, where you can subscribe to this podcast, comment, and find links to other information on note investing.
Hi everyone, welcome to the Note Investor Podcast. I'm your host, Dan Deppen, and in this episode, I'm going to be talking about forbearance agreements. Forbearance agreements are something that's been in the press a decent bit lately with COVID and everything else going on. A lot of the banks have been issuing these, and there's a lot of discussion about them in various parts of the media, but there's also a lot of confusion around what exactly they are and how they apply. So what I want to try to do today is kind of clear up some of that confusion, but then also talk about the way that I like to implement these and the structure that I like to use that I've had a lot of success with. So, but I'll kind of start by talking about what a forbearance agreement is or what forbearance is. So if we look at the dictionary definition of it, it's a temporary postponement of the mortgage payments. So basically, the lender is granting some relief to a borrower who has an inability to make payments. And it's basically an agreement you're coming up with in lieu of just proceeding with a foreclosure overall. The reason the lender is going to do this is because the lender thinks they're going to get a better outcome ultimately than just plowing ahead and going through foreclosure. And obviously for borrowers who may have hit some kind of a hiccup or a problem where they can't make payments, it's an agreement that lets them, eventually get back on track without facing the foreclosure. But there's a million ways that these things can be formed. So if you look at some of the ways that lenders will set these up, and this is where a lot of the confusion in some of the news stories happens because people make different assumptions. It's generally not just forgiving and writing off a certain number of payments, although it could be in some cases. Sometimes it could be the lender's going to just defer some number of payments to the end of the loan and then create a balloon payment at the end. The other one that I've heard of recently is sometimes lenders are deferring maybe 4 or 6 payments, but then there's a balloon due at the end of that period. So from some of the articles that I've been reading, some of the lenders have loans where say they're letting the borrower go 6 months without making a payment, but then they're expecting those 6 payments at the end of the 6 months, which I'm honestly not quite sure how that's supposed to work. That seems like a recipe for problems for everybody. And there are a million other forms of this. Now, the structure that I like to use, before I get into my structure, which is a little different than those, I just want to kind of reiterate that if you're a lender and you're going to grant a forbearance agreement, remember what your number one goal is. And that's that you're looking for a better outcome for you than you would get by going through foreclosure. And I've talked about this on several other podcasts, but if you do take a loan through foreclosure, take it back as an REO and sell it, your range of outcomes in terms of returns are all over the map, because usually when you get the properties back, they're usually not in great shape. So for me, I go out of my way to try to prevent foreclosure because it's expensive, costs several $1,000s. It can take a long time, especially depending on the state, or right now, this year with a lot of the courts shut down for a while due to COVID, and then even now the courts that are back open just being backlogged. I'm having a hard time getting hearings scheduled. Foreclosure can be a very long process, and it's generally financially never remotely as good an outcome as getting the loan reperforming. So really my goal with these is to get into a situation where we get the loan back on track. I can turn it into a performing loan and then resell it later on. So usually I'm going out of my way to try to prevent foreclosure. Of course, it doesn't always work. But remember, before we dive too deep into this too, that you have a counterparty on the other side, right? And the borrower gets a say in all this as well. And so you can create, the most optimized, elaborate forbearance plan that you've analyzed to death, but the borrower may or may not cooperate with it, right? So, there's a lot more art than science when you come down to it. But just remember that the borrower is always getting a vote. So like some of the big things for the borrower that could, change your plans are, number one, do they even want to stay in the home? If the borrower is ready to move on for whatever reason, it could be they're just ready to move. They're sick of the whole deal. It could be that there's a big crack in the foundation and they don't want to live there anymore, or the roof is leaking, or the furnace is dead and we're getting into winter, whatever. But if they don't want to stay there, you're not going to be able to get to some agreement that gets them paying again. Another thing is, do they even have the ability to make the payments that you would like them to make? I've got one loan right now where given the borrower's situation and the value of the house and the size of the loan, there's no scope to come up with an agreement that makes sense for me as the lender that the borrower would be able to actually perform on. And then another thing to consider is why they were behind on the loan in the first place. So oftentimes borrowers fall behind for reasons that are kind of temporary and they can recover from. So for example, if the borrower got hit maybe with some medical bills, it set them back, they stopped paying the mortgage, they got behind, and then, maybe the previous lender didn't really talk to them or work with them and they weren't sure what to do. And so they just kind of didn't want to throw money down the drain and then stopped. That can be a situation where, once the borrower gets through their medical situation, they can get back on track. Divorce is another big one that causes these to go red and stop paying. Sometimes it's a job loss where they're out of work for a number of months, but then they get working again. So those situations where the reason for falling behind was kind of temporary mean there's going to be a little higher probability that you can work something out and get something on track, because then it's more likely that they want to stay in the home, but they hit some hiccup. You also have to look at what their history has been and track record. They're definitely not the majority, but you do just get some borrowers who don't like paying their bills, right? And they've fallen behind because maybe the previous lender just didn't keep on top of things and either follow up with them or foreclose or do whatever they had to do. And they just kind of got used to not paying and nobody doing much. That kind of borrower is going to be more likely to not follow through on a forbearance plan or get through a forbearance plan and then have problems after that. And then some other things to consider too. So as I'll get into this, usually with these plans, I like to have some kind of good faith down payment. And so do they even have money to do that? Sometimes they don't. And then another one is, are the borrowers even responsive? Some borrowers you just cannot get a hold of no matter what. Although I have had some borrowers where I couldn't get a hold of them, wanted to work something out, could never talk, started the legal process, still couldn't get a hold of them. And then you get right to the end where they're about to lose the house, then they come online. And then all of a sudden they cough up a lot of money to reinstate. It's kind of weird. But, if you're trying to reach an agreement with the borrower and the borrower won't even come online and talk, well, it's a little bit hard to get an agreement in place. So sometimes, despite your best efforts, you're not going to be able to do anything. But given that, just want to kind of explain that. Now I'll kind of get into the structure of how I like to set these up. So my ideal structure is a forbearance agreement, and I call it / trial payment plan. So there's really 3 components to this. So with step number 1, which is the good faith down payment, this is what gives the borrower skin in the game. So what you want is, what you don't want to have happen is have a borrower make an agreement just as almost a stalling tactic and then just never follow through. So that's why I like to start off with as large as possible good faith down payment. So it gives them skin in the game. They've got an incentive to follow through because they're going to lose that payment if they don't. And then obviously from a return perspective, it's nice if you've got a non-performing loan to get this cash infusion. The second part of it are the trial payments. I usually set this up with 6 to 12. And the purpose of the trial payment period, so the good faith down payment comes first, then they're going to make 6 to 12 trial payments. And this is where the borrower demonstrates that they have the ability to make regular payments. So what we're leading to is the loan mod. So we want to make sure they have some ability to make payments on a regular basis, not just make a one-time payment. And then the third step is to modify the loan. And the way that you modify the loan, there are a lot of variables you can control. There are a lot of different ways you can do that. But once you get to the point where you have the loan mod in place, now the borrower has a current loan. They're at no more risk of foreclosure, assuming they don't default again. And as the lender, you've now got a much more valuable loan because now you've got a performing loan versus your non-performing loan. So you can sell this at, a much higher percentage of the unpaid balance than you would have than what you bought it for. And of course, and as we'll get into, there's some little tricks you can do to actually increase the amount of the unpaid balance as you do this. So I'm going to break down these three components a little more and go a little bit more in depth, because it's one thing to say what the three are, but then the next question is, well, what do I actually ask for? Which of these numbers actually be? So starting with the good faith down payment, obviously the higher amount that you can get, the better. Most of mine are in the $1,000 to $2,000 range. I've seen them as high as like $5,000. That's awesome if you can get it. So obviously it's better from the standpoint that you're getting this cash early, it helps your return. But remember, the main thing we're trying to do here is give the borrower skin in the game so that they've got this incentive to follow through and not just peter out, not follow through in the forbearance agreement where now you have to go back and foreclose. Ideally, if you're looking for rules of thumb, a lot of this will depend on the size of the loan and the payment. Really like to see this be about 3 times the size of the regular payment, and 5 or 6 is better. So let's say it's like a contract for deed with a $300 and $350 P&I payment. Getting $1,000 is not bad, although a lot of times I've gotten $1,500 or $2,000 on those. If you go below 3x, it's a little dicey. Although I've had borrowers make no good faith down payment and follow through. So it's a little hard to say. And again, a lot of this comes down to borrower behavior. You're never totally sure what they're going to do. You're just trying to stack the deck in your favor. But at the end of the day, too, when it comes to the good faith down payment or forbearance agreements in general, sometimes you kind of take what you can get, right? Remember that our goal here is to get an outcome that's better than a foreclosure. So for me, I might try a forbearance agreement without a good faith down payment, even though I know it's pretty flaky and it may not work. It can be worth giving it a shot to work. So if it does, now you get the performing loan. The risk is you might be just delaying when you start your foreclosure. So, but again, sometimes too, borrowers have really good stories on why they don't have any money to put down the good faith down payment, but that they can begin making regular payments. Now the trial payments. So remember, the purpose of the trial payments is for the borrower to demonstrate that they can pay on a regular basis. And so I've generally set these up as 6 to 12. When I started doing these a few years ago, I mostly did 12. I've increasingly been doing 6. And the trade-off there is, so from the standpoint of having more trial payments, the more trial payments the borrower can make, they're kind of getting more skin in the game as they go along. They're demonstrating a better track record. So when you ultimately modify the loan, there's a little better probability they're going to follow through, right? If you made it, let's say, real short, a couple months, they might be able to cough up a good faith down payment, a couple other payments, but then they're not going to stay on track necessarily. However, the downside of just increasing the number of trial payments as a lender is, if some of this depends on your timeline. Now, if this is just a note that you own in, say, a self-directed IRA and you just plan on holding this after it's performing, then I might just err on the side of more payments because I'm not really under any time constraints to try to get to an exit. If you've taken outside money and let's say you're doing a joint venture or something like that, and your joint venture partner has an expectation that they're going to get their money back within, 18 to 24 months, then that's a little bit more of an argument to get the trial payment shorter to get to the mod faster so you can get the new loan seasoned and then resell. and exit. So again, a lot of times these things come down to more art than science. Now modifying the loan. This is where it gets really weird, and I've got a pretty elaborate spreadsheet that I've built to kind of look at all the parameters so I can tweak some knobs and try to optimize these as best I can. It's not a spreadsheet that I actually share, but I'll explain the thought process behind it so that you can put these together yourself. So when you're modifying the loan, the one thing you could do is you could just create a brand new loan. So whatever you had before was a contract for deed or a mortgage, you could just have the borrower cancel that one and you could create a new one for scratch. It could be just a true modification where you're modifying some of the terms of the loan. If it's a contract for deed, one of my favorite plays is to agree to cancel the contract for deed, create a new mortgage, and convert it from a contract for deed to a traditional mortgage. This is nice from the borrower standpoint because now they're on title. They're not just doing a land contract, which it's a subject for another day, but to me, it's kind of like a glorified rent to own sort of a thing. I know it's not, lease options are different, but if you can create a traditional mortgage for them, then they're the ones that are entitled. They have the sense of ownership. They have more rights to it. It's a better situation for the borrower. And as the lender, since a lot of note investors are afraid to buy CFDs for various reasons, you can sell, all things being equal, you can sell a performing mortgage for more than a performing contract for deed. So that's one of the ways you can increase your value and your sellability of the loan, if that is your intention to turn around and resell it. Again, if this is something you're holding in an IRA, maybe you just plan to hold on to it, then you may not care about that as much. But the other benefit to doing that too is if you can go from a CFD to a mortgage, you're getting yourself off title. And that's nice too, because if the borrower starts racking up code violations or utility bills, there's some of these things where the city and the county come calling to you because you're on the deed. So getting off of that can save you some headaches as well. The other thing people do sometimes on these is they just take, the other big question is what to do with the remaining arrearages, right? So if this loan was non-performing, there's typically accrued interest, perhaps charges for taxes and insurance that lenders have paid over time. And sometimes when people modify these, they just tack that on to the back of the loan as deferred principal. That's one option. I'm not a huge fan of that option. You can also forgive some of the arrearages as part of the deal, and that can be an additional incentive to get the borrower to follow through. So there are a lot of knobs you can turn, a lot of options, and how you create these. But I'll talk a little bit about how you can structure these to try to optimize your ultimate return on the loan, which is really what your goal is. So when we structure the new loan, here's kind of my ideal template that I try to use. So number one is those arrearages, accrued interest, lender advances, late fees, etc. As part of the agreement that I've made up front is I like to roll those into the unpaid balance of the loan. So as you may or may not know by now, when you're pricing a loan, you always, especially if it's a non-performing loan, there will kind of be two values for the balance. There's the unpaid balance, which is the actual balance, and then there's the payoff amount. The payoff amount, involves all these other charges. But when you're pricing, you always want to price based off the unpaid balance because depending on how well the previous lender and servicer kept records, all of that payoff amount may or may not be collectible. But when we're modifying our new loan, if we take those arrearages and can roll them into the unpaid balance, now when we go to resell the loan, the buyer is considering that entire value instead of just the portion that was the UPB previously. So that's a great way to pump up your return, especially with some of these loans that have a lot of arrearages in them. Now, at the same time, if we're going to increase the balance of the loan, you don't want to just have to increase the P&I payment, right? Because you have a borrower who at some point was not performing on the old payment. You really don't want to raise it a lot because if you do that, how do you expect them to perform on that? So I try to keep P&I of the new loan around as close to the P&I of the old loan as I can. And so I tend to do that by stretching the loan term out, right? So from the borrower perspective, even though the UPB just grew, these are charges that they're still on the hook for. but you've kind of rolled that into the new loan without increasing their payment. You just stretch the term a little bit. And again, an additional carrot for the borrower to go along with this could be, if it's a contract for deed, converting it to a traditional mortgage and getting on title. So when you can roll those arrearages into the UPB of the loan, you can really significantly increase its value. It's one of my favorite things to do to pump up the ROI on my deals. All right. Now, again, so the next thing is, okay, so let's say you've looked at your loan, you looked at how far the borrower's behind, what the arrearages were, and you've come up with your perfect plan for your forbearance agreement that includes a good faith down payment of X amount, X number of trial payments, and then some sort of modification to a new set of loan terms, right? So now you got to have that discussion with the borrower to see if they're interested and see if they will go along with that, or have that negotiation. So, and my recommendation for folks, especially when they're newer, unless you've had the right training, is to have your servicer help you with this. There were some vendors I used to use for this previously that were no longer in business, but I think the best option is to draft your agreement, have a conversation with your asset manager at your servicer, and have them approach the borrower and be really clear throughout the whole process what all of your intentions are with this, right? So, I mean, your goal is for the borrower to be back on track. It might be to have them on title versus not be on title. And that, your intentions are, if you can't get an agreement in place, that you are going to follow through on the foreclosure. That's a whole nother topic for another day, is whether, is if you're going to follow through in the foreclosure or not. So a lot of lenders will buy a non-performing loan. They will try to work out these agreements, and if they can't, resell the loan. That's not my model. What I like to do is I just take them all to the mat, and there are some reasons for that, and that's another subject we'll get into another time. I don't want to detour too much here, but you do want to make it kind of plain to the borrower as well that you're offering a really good deal and an opportunity to get back on track, and the alternative is you're going to follow through on this foreclosure. So getting the agreement drafted, sometimes servicers can write these up for you, but if not, have an attorney write it up. Brian Gallagher is really good for a lot of these, depending on what state you're in. I like to use Franco Barilli for a lot of these as well, particularly Michigan, Indiana, Ohio, Illinois. And then kind of once you have an agreement in place, you can sort of use it as a template, but have someone draft this for you. I've got one that I like, and as things have evolved too, and sometimes it's rare, but sometimes I've had borrowers who have had attorneys to help represent them in this, and they've come back with different comments. So my agreement has kind of evolved over time a little bit, and it gets better and better and better. And again, like my spreadsheet, that's something I don't share, but talk to your servicer, talk to your attorney, and see what you need to do to get this drafted. If you just give them the high level terms of what you're trying to do, they can help you put this together. So now what happens after, let's say you've written your forbearance agreement, you reached an agreement with the borrower, maybe the borrower just accepted what you proposed, or maybe, they push back and you end up with something a little different than what you originally wanted. What happens now? And the big thing is, I think you want to monitor it very closely. And if the borrower starts to not follow through, or they miss a date for a good faith down payment, or they're a couple days late on the first payment, you want to intervene really quickly if they get off track, because I have actually not gone back and looked at my data on the percentage of the time where the borrower doesn't follow through, but a lot of these do fail, right? I mean, these are definitely not a foolproof thing. I mean, it's like everything, right? In the loan business, I mean, the proof is kind of in the pudding. I mean, my philosophy is, whether you're talking about a forbearance agreement or a sale of an REO or a sale of a note or a purchase of a note, nothing's ever final until the money hits the bank. So just having an agreement does not mean you're there. You got to see how well they follow through. So a lot of these do fail. And what you really want to do is either be, in some cases, what I do is follow up directly myself through either a letter or a phone call, but I would only do that if you have the experience and the training and you understand the rules around doing that, or have your servicer do that for you. But early intervention is really the key. Don't just let these things go. And sometimes they fail on the first one, and then I've tried again and had it go. I actually have one right now that we're on the third forbearance agreement, and this time it actually seems to be sticking. That's kind of rare. I don't necessarily recommend giving them 3 tries, but in this case, it's going to be a better outcome for me than if I had just gone through with the foreclosure. And remember too, like if you've started legal, sometimes what happens in these is maybe you can't get a hold of the borrower, and so you send a demand letter and you start the legal process. And so maybe it's just like the very beginning of the legal process, you send a demand letter. Sometimes I've had borrowers want to do forbearance agreements once we get really far down the legal process. Now, if you're in that case, you're going to want a much higher good faith down payment because you're basically want to get paid back for your legal expenses. But do remember, if you started legal and then you put an agreement in place and you accept a payment, if the borrower fails after that, you need to start legal all over again. So just keep that in mind. Stay in real close communication with your attorneys and your loan servicers as well. So sometimes what happens, let's say you've incurred a significant amount of legal expenses, and so to justify putting a forbearance agreement in place, you need a large good faith down payment. Let's call it, a $4,000 good faith down payment. You would want to give your servicer instructions that say, hey, expect a $4,000 payment, and please accept it. I understand this cancels legal. However, do not accept anything less, because what could happen in that situation is the borrower might send in $1,000 or a couple $100, like just send in a regular payment, and you don't want to accept that and have that mess up your legal process if that's what you need to do. And when we're designing this agreement, talk about some of the goals a little bit and some of the strategy behind how we're putting these together, right? So for the good faith down payment, it's pretty straightforward. You're really just trying to maximize. You're trying to get what you can, right? Because it's just better for you. You take smaller when you just don't have another choice. But then the big one is maximizing the value of the new loan or the modified loan that you've created. So rolling as many arrearages as you can into the unpaid balance is really helpful. I like to convert to a mortgage if it's a contract for deed, and if the borrower is agreeable, and if they can meet the Dodd-Frank rules, if you can get through the underwriting, then that's good. You can't always do it. You may have a situation where you want to convert it to a mortgage. The borrower would like to convert it to a mortgage, but their credit's terrible and you can't create a compliant mortgage. The other thing you can do to try to maximize the value of your loan is minimize the term. 10 years is kind of ideal. So I've had discussions with First National Acceptance who will buy performing loans, and they said that their ideal scenario for a loan was what they called 10-10-10. So 10% down payment, 10% interest rate, 10-year term. Now, in this case of a modification, you might have had a good faith down payment as part of your forbearance agreement, but then when you do create the new loan at the back end, there's not really going to be another down payment there. So that aspect of the 10-10-10 doesn't apply. And I'm not a huge fan of the 10% interest rate because I know some jurisdictions find that kind of usurious. So I'm usually setting it maybe around 8, sometimes less, it depends. But the 10-year term is kind of nice. So you can basically, if you set it up as a 10-year term, your P&I is going to be higher. And all things being equal, the loan with the 10-year term is going to be more valuable than the loan with the 30-year term. Again, that's probably a topic for another day. I don't have time to deep dive into the math behind why that is the case right here. And just remember too, as you're designing this agreement, right, we're always trying to, to maximize the probability that the borrower is going to follow through. That really trumps trying to maximize your potential return, right? Because if you get the borrower to reperform, if you can get it to a performing loan, you're going to be doing really great almost all the time. Now, if you can optimize it from there, increase the UPB, get the loan term just right, that's icing on the cake. You want to do that where you can. But the main thing is maximizing the probability that the borrower is going to follow through. So that can be, trying to get the higher good faith down payment. Sometimes forgiving arrearages can be part of that. Let's say the borrower has a lot of arrearages. Let's say it's, a $40,000 UPB and then $10,000 of arrearages. You might be able to work something out where say, okay, if you follow through on this agreement, I'm going to forgive a percentage of the arrearages. Or in an effort to get a higher good faith down payment, you may say, okay, I need a minimum good faith down payment of $1,000, and I'll match that in forgiveness of arrearages dollar for dollar. And if you want to make a higher good faith down payment than that, I'll match every dollar you put in dollar for dollar. So that can be, you can really get your incentives aligned with the borrower that way. And again, like I said earlier, this is a lot more art than science when you kind of get down to it, and you're always going to be kind of limited by what the borrower is willing to agree with and what the borrower is going to follow through on as well. All right, so I'm going to show a couple of quick kind of mini case studies on these, because this is really one area where, as I started doing more and more of these and learning about them and kind of understanding the math behind them, I think I'm a lot better at optimizing them now than what I was a couple years ago. I've done some of these where I put them together, and then we get to the loan mod, and I was kind of kicking myself because I saw things, later that I could have done differently that would have increased the value of the loan. So this case study number one, I'm not really going to get into the properties and the addresses because that's not really what matters. And I'm going to talk about a lot of numbers, but I'll try to keep it kind of simple and clear for those that are listening. So this was a note I paid $17,000 for and had an unpaid balance of $43,271. And it had arrearages of about $5,800. And the reason for the default was a divorce. So that's actually, it's not a good thing, but from the lender perspective, that's kind of a good reason, because that's something people tend to recover from. So in this case, we got a good faith down payment of $1,000 from the borrower, and then they agreed to make 6 trial payments of $621.97. The borrower completed the plan, so we rolled the arrearages into the loan, and then by the time you account for collecting the good faith down payment, the trial payments that came in, our new unpaid balance ended up being right about $46,000, right? So we increased the balance from about $46,000 from a little over $43,000, and we collected $1,000 up front and then 6 payments of $621. So about, $4,600, $4,700 altogether. And we got a loan with a bigger UPB that's performing. Now, again, the borrower doesn't always cooperate. Right after we modified the loan, the borrower missed like 2 payments right off the bat, which was brutal because I had already modified the loan. So was able to get the borrower caught back up, but that did decrease the value that I was able to resell the loan for. Was able to sell the loan for $26,800, which is not bad. I mean, it could have been a lot higher than that had the borrower followed through directly after we reset the loan. But still, if you look at this, we're in this for $17,000 and we're getting out $1,000 good faith down payment plus 6 payments is $621, and then sell the loan for $26,800 at the end. So the total ROI was about 38%. And there was a JV partner on this, so they saw half of that. They saw 19%. And the return, this took a little over a year till we did it. So the joint venture partner's annualized return was 16%, and that was after the 50-50 split, right? And this was not even that ideal a scenario. We got a relatively small good faith down payment and didn't even resell the loan for nearly as much as I would have liked to. So, if you really start digging into the math on these, you'll see that when you get these reperforming, your ROIs get really good, even with 50-50 splits. All right, so the second one I'll show. So this was a note that I paid $27,500 for. The UPB was around 45, and they had about 6,300 in arrearages. And I don't actually know what the original reason was for default. And so this was one where we couldn't get a good faith down payment out of the borrower, and they agreed to 6 trial payments. So this is kind of against all my rules. It's very dicey, but the way that I view this is I may as well take a chance on this, because if the borrower follows through, I'm going to do really well. And if they don't, I'm going to start the legal process anyways. And worst case scenario, I had a couple months to my timeline. Not a big deal for a shot at getting it reperforming. And in this case, the borrower did follow through, completed the plan, and then our new unpaid balance ended up being a little over $51,000, seasoned it for 6 more months, and sold it for $33,900. And again, that as a percentage of UPB is lower than what I would like to see on a reperforming loan, but the interest rate on the underlying loan was on the low side, so that can affect where you can sell it as well. And this worked out to a 24% ROI or 12% to the JV partner. And then the JV, but this was a pretty, relatively fast deal as well. And so their annualized return ended up being 15%. That was even after the 50-50 split. So point behind showing you these are just some of the ways they can go. Even if you don't get the perfect deal that you really, really want to get, you'll still do really well if the borrower ends up reperforming on them. So that kind of wraps up my formula for forbearance agreements. If you have any questions, please give me a holler. I'll talk to you next time. Thanks.